I'll be covering, topic lease financing. Okay. Have you ever studied lease financing earlier? Leasing?
No, sir.
Sure. तो आपने काफी सारी चीजें नहीं करी हुई हैं इंदर, because this is a final year and we have not covered so many things basically. तो आपके फाइनेंस के कितने सारे सब्जेक्ट अभी तक करे हैं आप लोगों ने? How many subjects you have done, Teja?
So mandatory we had mm, two. One is valuing enterprises,
Okay.
and last semester we had corporate finance.
Okay. So apart from that, any core subject? I mean, on like costing and other things you might have done,
Yeah,
isn't it?
costing we have done that, sir. Yeah,
Okay. And financial management and other things you have done.
yeah, the basics of finance, accounting and finance. Yes, we have done that. Costing, all
Okay,
three.
okay, okay, fine. Chalo, it's great. So let's start with, lease financing, okay? Fine.
Yes.
So Aman, Aman is there. Okay, who else? Others? कौन है जो?
Good morning, sir.
हाँ, good morning, good morning. Akshay is there. Okay, let me just have a. So now we are 11 altogether. So we have, including me, Adarsh, Akshay, Aman, Divya, Prachi, Rupak, Sakshi, Shivansh, Vyom. Okay, fine. So, so I'm just going to put up a slide and then I'll ask someone to read it. Okay, fine. Who is going to do that? Divya, are you going to do that, or Sakshi, or anyone, or Vyom, or anyone? Okay. So we're talking about lease financing. Can you hear me?
Yes, sir. Yes,
Okay.
sir.
Just let me just close the door here.
Yes, sir.
So basically, when you have to buy assets, when you require a certain plant, machinery, equipment, vehicle, anything, building, land. So either you can buy it outright, means you can buy in cash, pay the money and buy it, or maybe that you can take a loan from a bank and buy those assets. The third way of doing is lease financing. That means instead of buying, you take a plant and machinery equipment for your operations in form of leasing the equipment. Okay, so today we are going to understand this method. How do companies finance their assets? Basically by taking it on lease. Okay, so Vyom, can you read?
Yes, sir.
Is the slide visible? No, no, I haven't.
No, sir.
अच्छा तो मैंने अभी वो शेयर ही नहीं करी है. Okay. So let me just start. I'll read it and then I'll ask you whenever it is required. Okay. Vyom, so be standby. So leasing definition. Okay. First of all, we
Okay,
must
sir.
know what is the definition of lease. Okay. I'll just go read it and then we'll ask you later on to read. Okay. Fine. So a lease is an implied or written agreement specifying the conditions under which the lessor accepts to let out a property to be used by lessee. So basically, it's a written agreement between the lessor and the lessee. Whereas, the lessor, who is the owner of the asset, who is giving it on lease, to the person who is taking the asset on rent or lease, he's called the lessee. So there's a written agreement between the two guys to, let out the property which is to be used by the lessee. So we have a lessor and a lessee. Lessee is generally the owner of the asset, okay, or he procures the asset, okay. It can be a financing company or it can be a vendor, okay, who buys the equipment and gives it to the lessee on rent. For example, we go and take houses on lease. So there's a lessor who's the landlord, and lessee is the guy who's actually taking the house on rent. So this is one example of leasing. Basically, when you look at our normal area of actual happening in the world. So the agreement promises the lessee the use of property. So it basically the lessee can use the property for an agreed length of time, while the owner is assured consistent payment over the agreed period. So which means that the lessee is going to use the asset and lessor is going to get a rent for a certain period of time, okay, which is agreed in the agreement. So you can ask me a question if you don't understand. They are simple, but anyway, still, if you have some doubts and you want to clear, you can just interact and let me know. So the lessee, the person taking out a lease, agrees to pay the number of fixed or flexible installments over an agreed period of to the lessor, who remains the owner of the asset throughout the period of the lease. Now, the lessor is the owner, and lessee is basically enjoying that asset and using the asset for its business purpose or for personal purpose, for whatever. So, lessor remains the owner of the house, owner of the property throughout the lease agreement, and lessee has to pay a rent in order to use that asset. Okay. So, can you read this, Vyom?
Yes, sir. Leasing is a kind of financial service which allows the firm to use and control the assets without acquiring it. Leasing helps small firms to acquire assets of higher value. It is the form of renting of assets. The maximum period of lease according to the law is 99 years. Previously, land or real estate, mines, and quarries were taken on lease, but nowadays plant and equipment, modern civil aircraft, and ships are taken. A lease is a contract under which one party, the lessor, owner of the asset, gives another party, the lessee, the exclusive right to use the asset, usually for a specified time in a return for payment of rent. Leasing is the process by which a firm can obtain the use of certain fixed assets for which it must make a series of contractual, periodic, tax-deductible payments. A lease is a contract that enables a lessee to secure the use of the tangible property for a specified period by making payment to the owner.
Wonderful. So, let's analyze this, what is written here. So leasing is a financial service. Okay, it's a financial service which allows the firm to use and control the asset without acquiring it. So that means, you're taking an asset on lease. You're getting an asset financed to the lessor, okay, without acquiring it. So you don't become the legal owner of the asset when you're using it. The lessor remains the owner. Leasing helps small firms to acquire assets of higher value. So usually, the small companies, even big companies today, I mean, not from today, but from, past also. So they have been, renting the assets. So instead of, using their own money, maybe that, resources are not there. So sometimes they can't go to the bank. So they, get it leased. Okay. So it's a form of renting of an asset. The maximum period of lease, according to the law, is 99 years. Like, you find all those properties which are given by, DDA and in Delhi and other parts of the country, they are given on 99 years of lease. That's a maximum amount years where the asset can be given. And even it can be given for any, like an aircraft, company buying, airlines company buying an aircraft for a very long lease. So it can go up to maximum 99 years. Previously, land or real estate mines, quarries, they were taken on lease. But nowadays, we have plant, equipment, civil aircraft, ships, so they are also taken on lease. So a lease is a contract under which one party, the lessor, who is the owner of the asset, gives another party, who we call the lessee, the exclusive right to use the asset, usually for a specified time in return of payment of rent. Okay, so that we have already discussed. Leasing, the last paragraph is very important. Leasing is a process by which the firm can obtain a use of certain fixed assets for which it must make a series of contractual, periodic, tax deductible payments. So basically, when you are paying a lease rent to someone, it becomes your expense, and you can claim this as, you can claim, that as an expense in your deriving your profit and loss account. So that means they are tax deductible. So whatever rent you pay on the asset on which you are paying the lease rent, you can claim that as a business expenditure and claim a tax benefit. In case if you buy a building or a plant and equipment, so then what are the various things which are tax deductible? I mean, what are the normal expenditure which, a person who owns the asset gets? Anyone? Abhishek? If you buy an asset, so what form of expense you can take claim into your profit loss account?
So maintenance.
Okay, very good. What else? If you buy an asset of 1 crore rupees and use it for, suppose assume that the life of the asset is 10 years.
Depreciation.
Depreciation, sir.
Yeah, a depreciation. So you are allowed for depreciation and maintaining the asset, all the expenses. Okay. And if you're taken a loan, to get an asset, instead of going for a lease, you take a loan for, from a bank or any financial institution, then what are you allowed as an expense in your profit loss account? When you take a loan, what you have to supposed to pay to the bank?
So interest.
I think, yeah.
Interest. So that means interest, depreciation, and maintenance expenses. These are all allowed. They are tax deductible payments in case if you buy an asset from your own resources or you take a loan. So all these are expenses which you can claim from your profits. So it's an expense which is tax deductible. So a lease is a contract that enables the lessee to secure the use of tangible property for a specified period by making payments to the owner. So this is already been explained. So is there any doubt here? Anybody can ask question. If it is clear, then we can move ahead. Is the tax deductible part clear?
Yes, sir.
Okay, so I'll just have a check. So Divya, are you there? Prachi, are you there? Are you listening, Ridhima? Yeah, Divya? Now, tell me, I mean, any one of you out of Divya, Prachi, Ridhima, Rupak, or Sakshi, when you take a property, when you buy a property or a plant and machinery and equipment, so what are the various expenses which are allowed to you to be claimed and which reduces your tax liability? Yeah, Rupak?
Dep- Depreciation
Yeah.
and maintenance.
Huh? Depreciation and
Maintenance.
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 Yeah. But if you're taking the property on, the plant and equipment on loan, then what other benefit you get? What other things we can claim? The
Interest.
interest. Okay. So it's an interest, depreciation, and maintenance, which is allowed as a business expenditure if you buy an equipment, uh, I mean, yourself instead of taking on lease. But when you're taking a property on lease or a building on lease or a plant and equipment on lease, so what is allowed as an expenditure? Rupak? Now you don't own the asset. No, you can't claim the depreciation. You can't claim the interest. So what is allowed?
Lease payment.
Lease rent. Okay. So lease rent is allowed. Now, of course, as per the latest accounting standards, if not latest, but it has been there for last 5 or 6 years, even if you're owning an asset on lease, and if it's a long-term lease, okay, which is, using that whole economic life of the asset, then in that case, you have to capitalize, even if a lessee has to capitalize those assets in their books and can claim depreciation, but claim depreciation as per the Companies Act. Okay, but for income tax purposes, whatever I have explained earlier, that still holds good. But for companies purposes, they can report that as an asset. So they need to capitalize it. Okay, so whatever lease rentals they are going to pay, so they are going to capitalize all that in one go and claim depreciation. So anybody, why this accounting standard changes happened? Anyone? Why, the accounting bodies feel that the assets should be capitalized, even if they are taken on lease, but they are not, the real owner remains the lessor, but the lessee is also going to capitalize those assets. Why this, changes happen? Any idea?
So, probably because uh, instead of making them as an operational expense, if it is considered as capital, the value of the company will carry the cap. Uh,
Okay.
uh, right. I mean, the value of the company holds the overall asset because the asset is for very long time and can be considered as almost like a capitalized asset for the company.
Okay, so that's a good try, but Abhishek, since you're doing, you're from accounts, so why this change has led, you know, any idea?
So to maintain uniformity and any, so there are more innovations coming in. So to comply with all.
Okay, fine. No, okay, so most of you don't have the idea about it, but you have been trying it. I mean, you're this thing. What is happening was that, many companies, they were taking lots of assets, like, airlines companies taking aircrafts on long-term lease, and they were not capital, since they were buying it on lease, so that was not an asset which they were owning. Okay, so, all these were off balance sheet, items which were not reported in the balance sheet of a company. You own so many assets, and you're owning assets on long-term lease. Virtually you're owning, actually, if you're owning an asset for the economic life of the asset. Suppose the life of the asset or an aircraft is 10 years, and you have a long-term lease. So virtually, the person who is actually taken the aircraft on lease is actually using it as owner. He enjoys all the benefits, and he can, claim all the maintenance also of that asset. So all these transactions were actually reducing the assets and liabilities of the company. Fine, they were not being included in the assets, nor the liabilities. So in fact, many companies were in, if you take an asset on lease, it will reflect as a loan liability in your balance sheet, isn't it, if you buy it? But if you take on lease, it will not reflect. Fine. So it will, the financial analysts, the persons who are making, an analysis of companies. So if you look there at the two companies' balance sheet, one company which has, taken all the assets on lease, another company who hasn't, who has bought it and taken it on loan. So they will, give a different picture. Fine. So since, the transaction is basically helping, this transaction of long-term lease were helping, the companies not to report those liabilities into their books. And, in fact, it was their liabilities. So you can just read the accounting standards. It's very good. I'll just share that.
So
So yeah.
is it that it is actually inflating the account books of these companies who are leasing
No, actually,
rather than?
I don't know what do you mean by inflation. Actually, rather, I would say that, the balance sheets were not showing those assets at all in their books when they were owning them. Okay, virtually, if you're taken a long-term lease, as we'll understand,
Mm,
a long-term lease, that these leases are non-cancelable, and you are virtually the owner of the asset, and you're using them and
right.
not reporting them and in your books as an asset. Neither
Mm,
you're reporting the corresponding loans which you have taken or the liabilities which are there, because you're going to
mm,
pay a lease rent for a long period. So in fact, you have financed it. Okay, so that part of the money which you're going to pay to the lessor is not getting reflected
mm,
as a liability. Okay, in your balance sheet. So only when you pay, you in that year, you debit the lease rent and credit the lessor. Okay. So apart from that, these assets were, not being reported. So, many, almost like, I can just say on this thing that almost 30 to 40% of your, I mean, liabilities which are, balance sheet company has in the old world, they are not getting reported. Okay, so it was distorting the financial situation, that most of these, transactions, they were off balance sheet. So they were not
mm.
getting, into the balance sheets of the various companies who were having lots of assets on lease. Okay, so
Got.
it was for the purpose that, all the companies who have taken assets on lease, and if they're long-term lease, which we call
Yeah.
them, the finance lease, okay, which I'm going
Mm.
to explain much later now. So let's proceed and let's talk about that again. Okay.
Sure.
Okay. So is my slide up here? Is it coming?
Yes, sir.
Yes, sir.
Yeah.
So if you look at this, standard lease operations, so there is a lessor and there is a lessee. Okay. And there is an equipment supplier. Fine. So lessor would be generally a financer. He can be a leasing company, he can be a banker or financial institution who would, the lessee is going to finalize an equipment with the equipment supplier, and will ask the lessor to make a payment. So the equipment is sold to the lessor, and he will be making the full payment of the asset. And then the asset will get delivered to the lessee, and lessee is going to pay a lease payment, okay? And this asset will be given on lease from the lessor to the lessee, and lessee is going to pay a lease rent. Is that very clear to you, all of you? Any query here?
It's clear, sir.
Okay, so this is the kind of a standard lease operation process. Okay, so Vyom, can you read?
Yes, sir. Leasing financing. Leasing is a general contract between the owner and the user of the asset over a specified period of time.
So basically, it's a contract for a period. Okay, and it's a general contract between the owner and the user of the asset. Go ahead, Vyom.
The asset is purchased initially by lessor, leasing company, and thereafter leased to the user, the lessee company, which pays a specified rent at periodical intervals.
So that is what I have explained. We have seen the chart just before that. The asset is purchased initially by the lessor, who is called the leasing company, and thereafter leased to the user, who is called the lessee company, which pays a specified rent at a periodical intervals. So that rent which is paid is called lease rent. It is paid over either monthly or quarterly or yearly installments. Okay. Vyom. Okay. Thus, leasing is an
Thus,
alternative. Yeah. Go ahead, please.
thus, leasing is an alternative to the purchase of an asset out of own or borrowed funds.
So leasing is basically an alternate to purchase an asset out of your own or borrowed funds. Okay, so it is an alternate mechanism through which you acquire assets. Okay.
Moreover, lease finance can be arranged much faster as compared to term loans from financial institutions.
So basically, what happens is that the lease finance can be arranged much faster compared to the loans from the banks or financial institutions. Suppose if you want to buy a equipment or a plant and machinery worth, say 100 crores or 50 crores or 1 crore, whatever. So you approach a bank, if you want to take it on loan, the bank will ask you, you have to, there's a long, time frame in which your application will be processed. They'll be asking for your projected balance sheet, what kind of business you're doing, how profitable it is. So, they are going to, follow all the protocols, and it generally takes about a month or 2 months before the loan can be given to the company. So, whereas lease finance is much faster. So you go to the leasing company, they'll give you the asset in much faster, almost, 1/10 of the time the leasing company is going to give you as compared to bank. So that's why companies sometimes they want to buy the asset much faster and quicker because they want that equipment should be used for business and deployed for business purposes. And time is essence of the business. So they would like to go it for lease rather than going to the bank and taking a loan from them, which is a long-term, lengthy process. Okay. Now, there are two types of lease, very important, okay? And most of the time in your interviews, sometimes, this question is asked. There are two types of lease. One is called the operating lease, and another is called the financial lease. Have you ever heard of these two terms, operating lease and financial lease? Vyom? Akshay?
Yes, sir. Heard.
Okay. So, okay. I mean, let me just throw a light on that. You want to say something? What is operating lease, financial lease, or should I explain that?
So operating is generally for a shorter period,
Okay.
and financial lease is for a longer period in which
Absolutely.
it covers a more economic, basically economic
Life.
life of the asset, as well as it after the lease period is over, the lessor has a right to purchase at a lower amount that
Okay.
asset.
Sir,
Ah,
does that mean in finance lead, I can, let's say, use depreciation and, or amortization sort of technique,
yeah.
while operating lease, I'll only do the monthly transaction that I'll quote.
Sure. That's a very right thing. But you have said, as per the accounting standards, if an operating lease is less than 1 year, okay, and it is used for taking computers or any small assets then you can claim the lease rent as an expense as per the Companies Act. Okay, not as per the Income Tax Act, but as per the Companies Act, you don't require to capitalize the operating leases, which are for usually for a period of less than 1 month, 1 year. Okay, and they are for buying in assets, of small amounts. Of course, the international accounting standards have actually given a full, this thing that what kind of, lease would be actually an operating lease. Suppose a company enters into an operating lease for buying an asset which is very expensive, and the operating lease is for say 5 years or 10 years, then this will not be regarded as an operating lease as for accounting purposes. So the company needs to, capitalize even an operating lease if it is longer than 1 year. Okay. Now, operating lease basically, examples are, suppose you're taking a vehicle, taking a car. Like I use a car when I come to Shiv Nadar University, and it's provided by a transport agency. Okay, so he is giving that car to Shiv Nadar for the use of bringing their professors to the university. So that's an operating lease. Okay, for example, if you take there is a wedding in a house, and you take a shamiana or chairs or tables for on that particular day for a day or two, then that is an operating lease. Okay, operating lease is generally for a very short period of time, and you are not, the person who's giving, he's not recovering all the money which he has spent on that asset. He's just giving it on a shorter period of terms of lease, and to so many people, that's part of his business. For example, there's one more example. Like for example, suppose you are running a call center, and you have 100 seats, 100 call center agents are there. So you hire like 100 computers or machines which are going to be used by those operators. So you have two ways. You can purchase them, or you can take it on lease, as an operating lease. Okay, where you can where the owner of that laptops or the computers will be basically the person, the lessor, and he has given it on lease to the company who's running it as a call center. Now, anytime the lessee can return back those computers back to the lessor, or if there is some maintenance of machines and equipments are required for computers, so that will be carried out by the lessor and not the lessee. Okay, so he's just using them, and suppose he finds that he needs to return back, say he wants to downsize his call center seats to 50, so he'll return the 50 computers which he has taken. So the operating lease can be cancelled anytime. Okay, they are generally for a shorter period of time, where the owner, the lessee is basically not the owner, and he is just using it for a very short period of time. Whereas a financial lease, as Akshay has also said, it is generally for a longer period of time, which covers the full economic life of the asset. Okay, fine. So the Institute of Chartered Accountants or the accounting, now the rule says that you need to capitalize this financial lease. Okay, apart from that, even operating lease, which are for a longer period of time, where they have been termed as operating lease, but actually they are not operating lease, but they are financial lease. So they are called as operating lease because companies want to avoid them reporting as their assets and liabilities. So they follow that kind of a system. So whereas now the accounting standards have put everything on rest, that all the financial lease plus the long-term operating lease needs to be capitalized in the books of the lessee. Okay, so let's understand more. Okay, little bit. Vayom, can you read? Vayom, are you able to see the screen?
Yes, sir.
Okay,
The right to use the asset is given by the lessor to the lessee. The ownership right of the asset remains with the lessor. The lessee gives a fixed amount of periodic lease rentals to the lessor for using the asset. Lessor also bears the insurance, maintenance, and repair costs, etc. of the asset. In operating lease, the lease period is short.
So basically, you can understand here, what are the various things which you have learned from here. Look at the third box. Okay, so what does it mean, anyone? Lessor also bears the insurance, maintenance, and repair cost, etc. of the asset. So why he is bearing it? Why the lessor is bearing and why not the lessee? Akshay or anyone?
In the operating lease, since it is the short term that the lessee is going to handle the asset,
Yeah,
obviously he will not take the risk of the overall asset. So
yeah,
that still stays with the lessor. Hence, the lessor will have to do all these
yeah. Absolutely
administrative.
right. Absolutely right. Absolutely right. So basically,
Right.
he's not the owner, and the ownership remains with the lessor. So the lessor is going to bear the insurance and maintenance cost, and not the lessee. He's just taken it for a very short period of time. Think about, you're hiring a taxi. So you're taking it on an operating lease. You're not maintaining the taxi. The taxi is maintained by the owner of the taxi owner. So that's it's only for a short period. Okay. Vyom, can you read further?
The lease period is short. Lessor may not be able to recover the cost of the asset during the initial lease period and tend to lease the asset to more than one lessee. These are called lease and are cancellable with proper notice. The term of this type of lease is shorter than the asset's economic life.
So let's analyze this. Though this is for a short period of time, so we all know that there's no, I mean, confusion on that. Lessor may not be able to recover the cost of the asset during the initial lease period and tend to lease the asset to more than one lessees. So he'll keep, leasing those assets to as many as people he can, so that he can recover the cost of the asset and make some profit on it. These are callable. Okay, so these are callable lease and are cancelable with proper notice. So they are callable means that you can, the lessor can call the asset back. Okay, in case he requires that, he has given the asset and, he wants it back, so he can call it back. Okay, so he has full right. Suppose, you have taken 100 computers for running your call center. So you can even, cancel the lease. You can cancel the lessor or lessee. Both can cancel the lease anytime. The assets can be called back by the lessor. Okay. So this is, this type of lease is for a shorter than the asset economic life. So it will not cover the full economic life of the asset. Okay. Operating lease, the last one. Vyom.
The operating lease is attractive to companies that continually update or replace equipment and want to use equipment without ownership, but also want to return equipment at lease and avoid technological obsolescence.
Basically, what happens is that it is attractive for the companies, who want to continue update or replace equipment. The equipments, they get, obsolete, or they get out of, the technological changes. So they would like to, instead of buying the equipment or taking on, the finance lease, they would like to use the asset on an operating lease, and they can always change those assets as the new technology changes. So this helps, companies basically to acquire those assets and keep them upgrading them as soon as and when they want. So let's go to the financial lease. Vyom, can you read?
Financial lease is long-term in nature and non-cancelable. The lessee cannot terminate the lease agreement. The period of lease is generally the full economic life of the leased asset. The lessee has the right to use the equipment while the lessor retains legal title. The lessee has to bear the insurance, maintenance, and other related costs. It is also called capital lease.
So basically, we have done operating lease, now the financial lease. It's a long term, non-cancelable. So once you enter into a lease agreement, a financial lease agreement, it cannot be cancelled neither by the lessee nor the lessor for the period of the lease contract. So lessee cannot terminate the lease agreement. The period of lease is generally the full economic life of the asset. Okay. So this gives you a right basically to use the asset. The lessee can use it for the whole economic life of the asset without, the lessor retains the legal title. So the lessee doesn't become the legal holder of the asset. So lessee has to bear the insurance and maintenance and other related costs. So in case of a financial lease, it is the lessee who bears the insurance and maintenance cost. Whereas in the operating lease, it was the lessor who was bearing the insurance and maintenance cost. So it is also called the capital lease. Any questions, please, here? Is it well understood by all of you? Vyom,
Yes, sir.
Sai? Okay.
Yes,
So,
sir.
this is basically, normally in exam, you will have a question, where you have to explain, differentiate between the financial lease and operating lease. So, you can just read it. I'm just going to pause here. And if you don't understand anything, please ask me. I'm going to go to the practical question straight away. If you have any doubt with regard to anything, whatever is written on this slide, please ask me. Or you want to discuss something and ask me. We can discuss. If you have read, you can tell me, then we can just move to the question, okay?
Sir,
Yeah.
uh, the mining licenses that are given usually, that will be, well, financial leases, right, sir?
That should be a financial lease because, that is, you're going to use all the resources for a long period of time. So they are generally for a long period of time. Okay. If somebody gives, for example, which will not be the case, if the mining, kind of his lease is for just 1 year or 6 months, then it may be
Mm.
operating lease because you can't fully use all the resources. Okay. But normally it is a financial lease. Okay. Fine.
Yeah, so those are block deals with 30
Yeah.
years, 60 years sort of.
Absolute, absolute, absolute. You're right. So
So,
let's move
sir,
on. Yeah, yeah.
quick question there. So let's say if the new policies are coming in where we wanted to move out of, coal or, iron ore extraction to something else. So in such situations, how would the government compensate, which is the lease lesser, compensate the lessee, which is, let's say, a Tata Steel or maybe JW, JSW, etc.
No, what was the question? I couldn't get it. I mean, what was the government policies? What basically?
Yeah, so fundamentally,
Government
right now we,
policies that just to protect the environment. So they
right,
are closing down certain,
correct,
mining and all. Okay, so
correct.
fine. So here basically, again, though it is not in context of what we are studying, but it's a question where, suppose the government passes certain environmental laws which bans, mining. Fine.
Mm,
So
mm,
it should be basically loss for the lessor and not for the lessee. Lessee will not get a right to use that asset because it's totally banned. Lessor
mm,
who owns the asset because it is a long-term lease. It may be a long-term lease, okay.
mm,
But here the
mm.
lease has been broken because of the government intervention, okay.
Correct, correct,
So because the lessee could not use it for the desired period, okay,
right.
and the lessor who remains the legal owner of that asset is put in abeyance by the government, okay,
Yeah,
that they
yeah,
cannot be used. So
yeah.
I think
So the compensation for these lessees,
uh,
how would it eventually happen? I mean, was there any case that you can think of?
no, I don't have any case, and we have to read all the legal cases, or we have to see what the courts have decided basically. So
Sure.
this we can just research and find out. So that is not part of our topic here.
Yeah,
So we will
I
just
agree, sir. I
yeah.
agree. Yeah, sure.
Okay. So let's move on to a question straight away. Okay. Sai, can you read this question?
XYZ Limited requires an equipment costing 10 lakh rupees. The same will be utilized over a period of 5 years. It has two financing options in this regard. Arrangement of a loan of 10 lakhs at an interest rate of 13% per annum, the loan being repayable in five equal year-end installments. The equipment can be sold at the end of the fifth year for 1 lakh rupees. Leasing the equipment
I think
for a
Sai,
period of,
your voice is getting little bit not getting proper. So Vyom, can you read it?
So XYZ Limited requires an equipment costing rupees 10 lakhs. The same will be utilized over a period of 5 years. It has two financing options in this regard.
So
Arrangement of
let's read by one. So XY Limited requires an equipment costing rupees 10 lakhs. So there's a company who requires an equipment which is costing 10 lakhs. The same will be utilized over a period of 5 years. So this equipment can be used for 5 years. Okay. And the life of the asset is 5 years and the value of the asset is 10 lakhs. So it has two options, how to acquire that asset. Vyom, can you read? Vyom, can you read? Huh.
arrangement of a loan of rupees 10 lakhs at an interest rate of 13% per annum. The loan being repayable in 5 equal years and installments. The equipment can be sold at the end of fifth year for rupees 1 lakh.
So basically, you can, the first option is that he can take a loan of rupees 10 lakhs where he pays 13% interest rate per annum. And the loan is payable in five equal equal year end installments. Okay. And the equipment can be sold at the end of the fifth year for rupees 1 lakh. Okay. Further,
Leasing the equipment for a period of 5 years at an early rental of rupees 3,30,000 payable at the year end.
so basically, he can take it on a lease where he pays 3,30,000 rupees at the end of each year. He pays a lease rent of 3,30,000. Okay.
The rate of depreciation is 15% on written down value method, income tax rate is 35% and discount rate is 12%.
Okay, so the rate of depreciation of the asset is 15%, which is to be provided on WDV basis, and the income tax rate applicable is 35%. Of course, now the income tax rates have become quite low, but anyway, we have taken this assumption that the income tax rate is 35% and the discount rate is 12%.
Advice: which of the financing option should XYZ Limited exercise and why?
Okay, so this question is there. Okay, have you all understood what is the question? He has two options basically, either to buy
Yes,
the
sir.
asset on lease or he can take it on lease or he can buy it. Now tell me normally which would be always preferable. Normally, which mechanism would be preferable on the basis of expense, on the basis of which is more costlier, the leasing finance or the loan finance? Any idea? I mean, what's your general take on that? Whenever you take a
Uh,
loan, yeah, yeah.
Loan financing would be more expensive because of the interest rate,
Okay.
perhaps.
Anybody else? I mean,
Leasing finance will be more expensive.
who was saying that? Rupak, huh? Yeah, Rupak, you're right. Actually, the leasing finance is because he's a banker, so the leasing finance is always expensive. Because the banks generally charge a lower rate of interest compared to a leasing company because it is much quicker to get an asset on lease. So the leasing companies make a good amount of profit, when they lend. Okay, and they are doing only the business of leasing, whatever reasons it is, I don't know. But the leasing equipment, getting it on lease is always costlier compared to taking a loan from basically the banks who are regulated by the central bankers. So then they can't keep very high rate of interest. They have to keep a certain rate of interest which covers their the cost of their funds. So the leasing companies generally charge a much higher interest rate compared to the banks. So that's basically trend in India, okay, and maybe in Nepal also. So leasing
Uh,
is yeah,
so, quick
yeah.
thing. Can NBFCs considered as, an example? Would they do leasing finance?
There are many. I mean, there would be companies like NBFC companies. They would be in a process of leasing. Okay, fine. So you can check on the Google. Which are the companies which are doing leasing. So you'll find so many companies, and they will be one of them. Maybe even NBFC companies. Okay. So rather, they are all classified as non-banking finance companies basically. So any company which is other than the bank, which are called full-fledged banks. So rest are all, they're not accepting, things. They're not having a saving account or various kinds of accounts with them. So these are non-banking financing companies. So we have to look at the RBI definition. But mostly NBFC companies would be basically interested in leasing the equipment to their clients. So you're right in saying that. Okay, fine. So let's do this question. So I'm just opening an Excel sheet which I'll share with you later on your portal. So this was the question. Are you able to see the question slide?
Yes, sir.
So this is the same
Yes.
question which I put on an Excel sheet. So let's talk about the loan first of all. So please focus here. I'm going to use some formulas. So what is the total amount of loan the company is going to take? 10 lakhs. And what is the rate of
10
interest?
lakhs.
The rate of interest is
13%.
Okay. So now we have to calculate. They have to suppose to pay the money in 5 installments. So how do we calculate that? I'm just going to put a cursor here, okay, and go to formula. So first we'll check what is the formula which is used, which is PMT formula, okay. So one way is to use the formula. In real life, you'll be always using Excel sheet for doing it. Look at the PMT formula, and rate of interest is 13%, okay, and the period is 5 years, okay, and the future value, that means the money which you are supposed to give, is 10 lakhs, okay. Where am I missing? So I'll just use it again. PMT.
Sir, is it few? Okay.
I made some mistake. 13%. NPV is how many? 5 years, isn't it?
Yes, sir.
And so this is what you're going to make the payment. So maybe that I think I've used here. Okay, so 10 lakhs. Fine.
The present value is 10 lakhs, sir.
The present value is 10 lakhs. Okay. So that means if you press this, you will get the answer here. So you are going to pay 2,84,000 as an EMI. Which means if you pay 2,84,000 every, so this is how we
Sir,
are,
sir, 28 lakhs. 28 lakhs is what we are going to pay.
2,84,000. It's 10 lakhs.
Oh, is it? Okay. Oh, okay.
The amount is 10 lakhs, so he's going to pay 2,84,000 per annum as EMI. So how do we calculate the EMI? So let me just show you again. You go to formula here, go to PMT, okay, pick up the rate which is 13%, okay, and you have to pay this money in 5 installments, okay, and put in the present value, put this amount, okay, just put this amount, okay, so you will get your installments. So this is the installment you are supposed to pay, okay, every year. Now you're going to bifurcate. So this is the the installment which you have to pay to the bank, equated yearly installment. Okay, we can even do it equated monthly. The question is that he is going to pay yearly, so we are calculating the EMIs yearly. Now you have to calculate the interest. Okay, so how the interest has been calculated? So you can just look at it. So it is basically 10 lakhs into 13%, which is 1,30,000. So the first full year you have used 10 lakhs and paying the installment at the year end. So that means you have to pay 1,30,000 as interest. Is it clear? So balance is your principal. So this is the principal
Right,
which
sir.
will remain. Okay, so that
Yeah.
means in your 2,84,000, 1,30,000 is interest. So principal you are paying is 1,54,000. So how much will be the principal left? So principal is what? Basically you are making that 2,84,000 minus 1,30,000. So you get 1,54,000. Okay. Now the outstanding balance will be this, which is 10 lakhs minus 1,54,000. So 8,45,000 is the balance which is appearing. Okay, as a loan outstanding. Okay, fine. So next year you're going to pay again 2,84,000. So the interest would be, if you just trace down, the interest would be basically the interest, it will be paid on 13% on the principal outstanding, which is 1,09,000. Because you had paid 1,54,000 out of 13 lakhs, so 8,45,000 was remaining at the at the year end next year. So for the whole year you're going to pay 13% on that. Okay, fine. So I'm going to remove that. So the principal amount will be the difference of the two, 2,84,000 minus 1,09,000. So this will be your principal outstanding left, which is basically 8,45,000 minus this principal which you have paid the current year or the second year. So this will be your remaining. So are you understanding, everyone? Any questions, please? I can repeat that if you want. So third year, like this, you have done it. Okay, interest, principal, and like this. So, and in the final year, your principal outstanding will remain zero. Okay, since you have paid everything. Okay, so is it clear?
Yes, sir.
Yes, sir.
Any questions here? Anyone? Rupak, have you followed? I mean, of course, you will be following it definitely.
Yes, sir.
Okay. Now, you will be dully doing in an Excel sheet. Okay. But sometimes you don't use an Excel sheet. So what we use is that, like for example, you're giving, a person one rupee every year. Okay. Which means that, okay, I'm just going to skip that. So I'm not going to cover that because you are going to use the Excel sheet anyway. So we are not going to cover that and do a process which was being done earlier. So we're not going to do that. Let's go to depreciation. Now, for the depreciation, the equipment is costing 10 lakhs. And what is the depreciation? 15%. So the first year depreciation is going to be 1,50,000. Okay. Fine. This is, 15% of 10 lakhs. Fine. And the return on
Yes, sir.
value will, yeah, return on will be 10 lakh minus 1,50,000. Is that okay?
Yes, sir.
Yes, sir.
Then you start with 1 lakh, 8,50,000 again. And depreciation will be now 1,27,000, which will be 15% of 8,50,000. Okay, fine. So this will be your balance. Then you start with this again opening balance and take a depreciation on 13% on this amount. Okay, which will be basically 15% of 7,44,000. Okay. Then similarly for the fourth year, the depreciation will be the return on value on the beginning of the fourth year into 15%, which is 92,000. And similarly, you can do it for the final year. Okay. Is it clear?
Yes, sir.
Okay. Now let's go to the cash flows. Let's understand now we have all the inputs now with us. So we will work out what will be the cash outflow on both the leasing option and as well as on a loan options. So let's start with this year one. How much is the EMI? 2,84,000. What is the interest component included in this? 1,30,000. And what is the depreciation, which is just calculated in the depreciation sheet? So total amount of,
150,000.
yeah, if you are owning the asset, if you're taking a loan, what is allowed as deduction under income tax? Interest and depreciation. Okay, 2,80,000. Now, since you are in 35% tax bracket, so there will be a tax shield. So you will be actually, in fact, your total outflow will be only 1,86,000. So because you will be claiming this as an expense 2,80,000, so this will be you're going to reduce your income tax liability in that year, and your outflow will be only 1,86,000. Okay. Now this is happening after 1 year. So that means you're paying this EMI after 1 month. Not EMI, rather, it is actually equated yearly installment. So you're going to pay it after 1 year. Okay. So the present value, because they said 12% is the discount rate, okay, which may be the cost of capital of the company. So you calculate what is the present value as of today, of this 1,86,000. So you're going to spend 2 lakh, 1 lakh, 2 lakh 1,211 cash flow in the second year, third year, fourth year, and fifth year. So what you are going to do is you are going to calculate the present value of everything. And how we have done the present value, you can always, do that. Like, you just put the present value here. Okay, present value. So rate is how much? 12%. Okay, and NPR, suppose say 1 year. And so 1 rupee which you have paid after 1 year is equivalent to, as of today, is equivalent to 0.893. Okay, fine. So which I have written here. So I can always, have you followed that? I'll just do it again. So 1 rupee which you have paid after 1 year, you have paid 1 rupee after 1 year. So today, what is the value of it? It is 0.89. If the value of 1 rupee is 0.89, the value of 1,86,000 would be 1,66,000. So I'll just put the formula again. Here we are calculating the present value. So we are saying the rate of interest is 12%. Okay. So, after, suppose you are paying me 1 rupees, sorry, which means that, if I give you 89 rupees, 89 paisa today, okay, you give me 89 paisa today, and after 1 year, I'll give you 1 rupee. So which means that you're earning 12% rate of interest. So it may be looked at that also. So this is the 1 rupee present value. This is the 1 rupee present value after 2 years. This is 1 rupee present value after 3 years. This is 1 rupee value after 4 years. And this is 1 rupee value after 5 years. So whatever amount you are paying, okay, you are calculating the present value. And in the 5th year, you're also getting 1 lakh salvage value. You know, when you own the asset, you can sell it as a scrap after 5 years. The value is 1 lakh, which is given in the question. So you also calculate that. So that means the present outflow of cash, if we are using a buying option or taking out loan, is 7 lakhs 9,408. Now we will also calculate the present value of the lease option and compare them, okay, and find which is better. So have you understood? I mean, should I explain this again, or is it okay to everyone? Or can we discuss that, how we have calculated this? Sai, have you understood?
Yes, sir. Yeah, I'm following.
You're following. I mean, any queries, any questions?
No, sir. We just have to go on hands-on for the present value factor calculation. But I'll learn that
Okay.
once you
Now,
share the sheets.
you know, actually what happens is, let me just, I mean, you can of course learn it yourself. That's always better. What I'm saying is that if I give you, if I'm spending something, after 1 year, what is the present value of that thing today? So I'm going to spend 1,86,000 after 1 year. I'm going to spend this 2,01,211 rupees after 2 years. This I'm going to spend 2,15,000 after three
Yeah.
years. This I'm going to spend after 4 years, and this is I'm going to spend after 5 years, and this is I'm going to get after 1 year. So if I get everything today, fine. Suppose if I have to spend all the money today, so what is it worth? It is worth 7,09,000. So 1,01,000 which I am going to get after 5 years, it is worth only 56,000. Okay, fine. So what I'm saying is that my total cash outflow, if I do all this, on a present timeline, then the value today which is moving out of my, cash is 7,09,000. So this is the present value of all the cash which I'm paying. If I have to just compare, how much I've paid, and I calculate, what is the present value, this is 7,09,000. Okay. Now you'll understand this
Right.
as we do the leasing option. Now, leasing, you're paying 3,30,000 as lease. Okay. And you're paying 35% as tax. So what is the outflow per annum? 2,14,500. So this is what you're paying. Okay. Every year. So let's move here. You're paying every year all this money. Again, applying to the present value concept. So all this is equivalent to 7,73,000. Okay. So if you're paying 2,14,500 and if you use a discount rate of 12%, now why this discount rate of 12%? Because this is the cost of capital, or the cost of capital of this company. So we are assuming that this is the cost at which they are borrowing money, okay, or they are running their business, rather not borrowing, but this is the cost of capital is used as the discount factor to calculate the present value. So it is 7,73,000. Okay. Now, when you're using a debt function, when you're buying the asset on loan, you're spending 7,09,000, and in the lease option, you're spending 7,73,000. Okay. So which is better, the taking it on loan or taking on lease? Tell me.
So taking on loan is better.
On that, yeah.
On debt. Now, how we have calculated this 7,70,000? I've shown the calculation, but you can do again here. Okay. So you can use the present value function. Okay, here. Recently use present value. Okay. So rate is how much? 12%. Okay. You can do it for everything. Year is 5. Okay. And how much installment you are paying today? Minus 2,14,000, or I can just this also and put a minus sign in front of that and calculate. So you get 7,73,000. Using straight one stroke, you can calculate using the PMT formula. Okay, the present value, whereas you have to put the money in only PMT because you are paying yearly PMT, that is annuity. Okay, so rate is how much? 12%. Fine, and year is 5. Okay, and PMT is going to be this amount. Okay, fine. So if you do that, you will get 7,73,000 as your. If you put a minus sign, so this is going to be the present value of the cash outflow. Okay, fine. So this is doubled actually because we have used it twice. Okay. So what we are trying to do is, I'll go back and explain again. If you use a debt option, your total outflow is 7,09,000. If you use a lease option, the present value of all the cash which you're giving in 5 years is 7,73,000. Here, whatever money you're paying as a yearly installment is worth today's 7,09,000. So your outflow on both the occasions on a basis of present value is this much. So you find that you are paying more here. Okay, by how much? This minus this, isn't it? If you calculate, you're paying 63,000 more in the present terms. Okay, so let me just go back to you here again. So and stand here, which is the long calculation. Your equated yearly installment was 2,84,000. Okay, where 1 lakh was 30,000 was interest, depreciation was 1,50,000. So that means the total expense which you can claim under the income tax is 2,80,000. But since you get a tax, a shield, that means your tax rate is 35%. So your total outflow will not be 2,80,000, it will be 1,86,000. So the rest of the thing will be borne by the government in form of tax benefit which they're going to give you. Okay. So since your tax liability will get reduced because it is a tax deductible expenditure, so you are going to actually spend only 1,86,315. Okay. This way you have calculated for all the 5 years, and in the fifth year you're getting 1 lakh rupees back from the sale of the old asset, the scrap. Okay. What are you trying to do is you're calculating the present value of all this money which you are going to spend in different time frames, and just bringing them in the present time frame, that if you spend today all this amount, which is equivalent to 7,09,408. Is that clear? Any questions, please? If of course I'm going to share the slides and everything, but is this clear to everyone? Yeah.
Yes, sir.
Vyom, have you followed it?
Yes, sir.
So what we do basically when you have to find out which asset is better, leasing or financing. So what we usually do basically, what we have done in this question basically, हमने करा
Sir,
क्या है?
basically after finding out the yearly payment, we have deducted the interest and depreciation from it and find out what was our tax benefit. Afterward, we calculated what was the cash outflow that was going by deducting the yearly payment with the tax benefit that we have gotten.
Yeah.
And then we applied present value formula and got the what was the present value of the future outflow of the cash, and got to 7,07,000 for your loan, and for leasing we got around 7 lakh, more than 67,000 more than the loan amount.
Absolutely.
So
So idea, definitely, Vyom, you have got it right. That what we have done is basically we have tried to find out what is the present out in terms of present cash. What is the outflow? If all the money is spent today in both of the kind of transaction, what is my cash flow? And then I compared that cash outflow between the leasing and taking a loan, and found that the taking on loan was much cheaper compared to taking on lease, because my present value of the cash outflow is much higher in case of lease. Okay. So but because we are spending the money in every year, after 1 year and 2 year and 3 year month, but in actually we spend on a monthly basis. Okay, so we spend after 1 month, 2 months, 3 months, like this. So but in this question the installment is yearly, so we are spending all the money after 1 year. Okay, so if we have to compare the two things, so first of all we have to brought all the two things have to be brought under the present time frame. So that's why we use the present value function, basically formulas, to find out what we are going to spend if all the money was spent today. And then we compared which option is better. Is it the leasing or is it the financing? So we found that leasing was costlier. Okay, usually, I mean, in most of the time, the leasing will become a costlier mechanism to finance rather than taking a loan from the bank, as what Rupak also agreed with me, since he's a banker. So the banks generally charge a lower rate of interest compared to the leasing companies who charge a very high rate of interest. Is that okay? Have you all followed? Any questions, please?